Good morning. I'm Professor Laurie Hodrick, the founding director of the Program for Financial Studies. I'm delighted to welcome you to the 4th Annual Program for Financial Studies Conference. Today, we faculty members, students, alumni, and practitioners gathered together for a question about the quest for yield. What is yield? Let's begin with the definition. The total percentage return of an investment equals its capital gain, measured as its percentage price change, plus its yield, which is the income received, measured as a percentage of the price. The yield on securities has always been an important component of the total return for investments. This income comes in various forms, including the dividends associated with stocks and the interest or coupons associated with bonds. For the past 87 years, for example, dividends accounted for 34% of the monthly total return of the S&P 500 index. Since the financial crisis started 6 years ago, we've been in an era of low interest rates and sluggish growth, and we've witnessed an extraordinary compression of yields across a variety of asset classes. U.S. Treasury notes maturing in 10 years carry a yield of just 2.39%, compared to the average yield of 6.32% since 1958. The real yield on the 10-year inflation-protected Treasury security is a mere 30 basis points. The one-year Treasury bill is offering only 12 basis points. With inflation at about 2%, investors who keep their money in one-year Treasury bills will have lost about 8% of their purchasing power over the last 6 years. These low yields are matched by sluggish real GDP growth, averaging only 2.2% for the last 3 years, compared to 3.3% from 2004 to 2006. The rate of growth is even lower in Europe, and as rates have fallen there, major banks have recently begun charging their large customers 20 basis points per year to deposit euros. This situation has driven investors to seek vehicles that pay a relatively good yield now and offer potential for future payout increases. Equity investors chase dividend yield, with many companies paying dividends in excess of their own bond yields. The yield spread of U.S. BAA-rated corporate bonds over the S&P 500 index dividend yield is at a near multi-decade low. The quest for yield has also driven bond investors towards increased risk, notably high-yield corporate bonds and those emerging from emerging markets. But even these investments have historically compressed yields and come with possible default risk. Corporations have responded to this low-yield environment with record bond issues. In the past 5 years, U.S. corporations have raised over $2 trillion in new debt, bringing their total debt burden to almost $10 trillion. Corporate borrowers in both tiers of credit risk, investment grade and non-investment grade, are on pace to supplant last year's borrowing record. Companies have also increased their sales of convertible bonds, looking to raise money at rates even lower than ordinary bonds. For investors, the allure is the extra profit if the issuer's stock price rises. Low yields are also reflected in the magnitude of other accrued liabilities, such as fiscal burdens, which are also growing. The Society of Actuaries estimates that the average funding ratio of state and local governments, after rising from 79% in 1990 to a peak of 103% in 2000, have declined to 73%. Some states and municipalities use high historical average returns to discount these liabilities, an assumption very unwarranted in the new low-yield environment. And of course, these unfunded liabilities are dwarfed by the magnitude of the unfunded promises that the federal government is making. Half of the $3.5 trillion federal budget is currently spent on Social Security, Medicare, and Medicaid. And we are living longer, but not retiring later. Comparing future taxes to future expenditures based on the Congressional Budget Office fiscal scenario projections, there are $205 trillion in present value of unfunded liabilities. This quest for yield environment leaves many questions unanswered. When will interest rates rise? What will it all mean for Wall Street and for Main Street? To consider all facets of the quest for yield and answer these important questions, the program agenda proceeds as follows. We begin with our keynote address by Mark Gallogly, followed by 2 concurrent panels. Panel 1 will discuss asset management and will be held in this room. Panel 2 will discuss corporate finance and will be held in the Seytal room, also on the 5th floor. Information about the panelists is available in your program, and your name tag indicates which panel you have selected. There will be volunteers wearing blue ribbons on their name tags who stand ready to assist you as you head to your next location after the keynote is finished. After those panels, current Columbia Business School student attendees will join panelists and members of the advisory board of the Program for Financial Studies for a luncheon in the Broadway Room, which is on the second floor of Lerner. Both panels, as well as the keynote address, are being videotaped, as you can see, and will be posted on our website. So if you're interested in experiencing the other panel as well, or if you'd like to share what you experienced today with some of your friends and others, you'll be able to access our videos online. Finally, let me gratefully acknowledge BNP Paribas for their sponsorship of this conference. It is now my pleasure to introduce Dean Glenn Hubbard, who will introduce the keynote speaker.
Thank you, Lori. Good morning, everybody. If you are an alum, welcome home. If you are a student or colleague, thanks for joining this program. I think there is a lot to discuss today. And Lori, thank you especially for your leadership of something so important for the school and for the university and obviously for people here. You know, Herb Stein, who was the only chairman of the Council of Economic Advisors to have a wit and be entertaining as a speaker, once said something to the effect, and I always get his quote slightly wrong, that something that can't go on forever will stop. Now, that at one level is quite definitive and quite true, because while one can argue in life about politics, one can argue in life even about economics, one cannot, of course, argue about arithmetic. So the mechanics of stopping must be true, but the question is how. Now, there's nothing probably more vexing right now to financial market participants and to economists is this topic of the quest for yield, because in the minds of many, and I would put myself in that group, one thing that probably will stop is a view that growth is permanently slow, which would have very significant effects, obviously, on capital markets and on interest rates and asset prices. There are, of course, perfectly respectable people with the alternative view that growth will be slow, and that will also have the opposite implications for interest rates. Which of those scenarios prevails obviously tells us a lot, along with the course of monetary policy actions that will be taken all over the world. But we're fortunate because we're going to learn the answer to those questions this morning. So that's one reason I'm here, and I'm sure you're here, from Mark Gallogly. Mark Gallogly and his wife Lise are both Columbia Business School graduates, longtime friends of the school. Mark serves on our board of overseers. He was for many years at the Blackstone Group running private equity. He, of course, the past several years has been at the firm. He founded Centerbridge, which just had a very successful fundraising, so congratulations, Mark, on that. And I am delighted that he is going to spend some time with us today to talk in this area of quest for yield about where we are headed and what we should look at to judge. And then there'll be that takeaway when he gives us that answer of up or down. Mark, thanks for coming. All to you.
Good morning, everybody. Glenn, thank you. Thank you for that introduction. Professor Hodrick, thank you for having me. I also want to thank one of my partners, John Lewinson, who's not here today but spent time on this presentation with me, and one of my colleagues, Steve Dickerson, who is here. Where is Steve Dickerson? There he is. Stand up, Steve. So Steve is a young guy who's going to be here for the morning, and there are a lot of people who have thought about this deeply in this room, and I'd love Steve to get to know some of you. He's a good fellow and worked on this hard. Final congratulations to Glenn on the election Tuesday. Glenn and I are friends. I am on the other side of the aisle. But we share a desire to move America forward. So congratulations to him. Never in financial history, arguably, have rates been so low for so many for so long. It's never happened before. Not just in the United States, but in developed markets around the world. Now, the GOP is taking over. This is my last political comment, but we can come to this in the Q&A. The Senate and the Fed is going to be under additional scrutiny. is that going to impact how we think about this question that we're talking about? Maybe we can get to the Q&A with our distinguished dean at the end of this. The markets anticipate that rates are going to stay low. The markets think rates will stay low. You know, capital markets are ever creative in the United States. So if they think rates are going to stay low, what will we do? We'll invent new products, right? And those new products will allow us to achieve real yield, or maybe even not the search for yield, but the stretch, you know, a real stretch for yield, especially given the comment that both Lori and Glenn made about liabilities. If your liabilities are expectation is 7% and you've got a 10-year at 2, well, you have a problem. You have to figure out where you're going to get the money from. This is either a great opportunity for patient investors looking at it, or it's a real danger. And the danger could come, how could it come? If markets move unexpectedly quickly, if the market gets caught off guard. In the next 30 minutes, I'd like to talk a little bit about where I think we are now, what I see the markets doing in reaction to current yields, and what I think the future might be. Before getting started with my talk, I want to make a couple quick personal comments about where I'm coming from in this, and a little bit about our firm and our investment philosophy. I was at Blackstone for 16 years and ran private equity there. Started Centerbridge with Jeff Aronson. Jeff has been a great partner in this adventure. We've been doing it for about 9 years together now. His background was as a credit investor at Angelo Gordon, so his markets are very much yield focused. We took 2 strategies under one roof. We bridged these 2 strategies to the center with the idea that if you have a good understanding of the asset side of a balance sheet, how businesses work, what strategies work, how to attract great management teams, thinking about the competitive edge that a business might have, that would be a good thing to understand, and hopefully how to improve businesses, their profit margins, and grow their profits and their employment. And at the same time, if you take a market perspective, which has been Jeff's background for the last 30 years or so, put them together with one team of about 60 people, which is what we have now, investment professionals, managing about $25 billion here and in Europe, then we have an opportunity to take advantage of both of these in a dynamic market. I'm a CBS alum. I met my wife at CBS, so I love Columbia by definition. You know, here I learned a number of things, but one was, what is your competitive advantage? That's the question to always ask. I think ours as a business is that we hope we are more nimble, right? We think that we're able to take 2 complementary strategies, effectively countercyclical in many ways, and put them under one roof and allow ourselves to take advantage of that level of integration to get better returns. Okay. As investors, last comment on this topic, and then I'll get into the substance of it. I think we're very much in the Ben Graham school of thinking. I was taught here by Jim Rogers, among others, and really try to think about what is the value of an underlying security that we're acquiring, or an underlying business. What's the real value? What level of safety do we have in that investment? What level of risk are we taking? Are we remembering the first rule? Don't lose money. That's our first rule of what we're looking at doing. And think about the margin of safety and the absolute returns in any situation. So where are we today? Well, as Glenn can tell you, he and I think, share this. We're both quite bullish on where the U.S. is. I think I'm bullish from an economic point of view, overall as a person, and even from a competitive edge point of view. I think we have a distinct competitive advantage. Perhaps that's a discussion for another day, since we'll focus more on spreads today. As it relates to interest rate and the search for yield, today, as I said, the market has virtually no historic antecedent. Yields are famously low, but how low? How low are they? Well, in nominal terms, and I've taken the liberty in it's kind of an analog way, I'd say, of handing out, or Steve has handed out, some presentations here. I'm going to flip through these. Don't worry. Unlike school, you can flip ahead if you want. This is slide 1 I'm talking about now. So in nominal terms, sovereign yields have only approached the current levels after the destruction of World War II. That's basically it. And it's true across virtually all major developed countries. You have to go back to the mid-1800s, and in the case of the Netherlands, to the 16th century to find the kind of yields that we're dealing with now. Slide 2, the 30-year US long bond. It's the same trend, and it's even more remarkable when you consider that prior to the Great Depression, the US experienced repeated and sharp moments and periods of deflation. As students of markets, we've seen rates follow long, secular rises and falls. And if you consider the period in which the business that I've been fundamentally involved in, private equity, so I joined the world of finance in 1980, and have been in private equity since not very much longer after that. And you know, what's happened over that 35-year period? Well, rates have gone straight down, straight down. Who is the biggest beneficiary of this? Okay, I would say, does anyone know John Gray? A fellow named John Gray here in New York? Okay, so John runs private equity at Blackstone. I think he is the single biggest beneficiary of this, okay? I've told him this many times. He may be a little bit too young to be, maybe the Rudin family here in New York, but it's incredible. Rates have gone straight down for 35 straight years. Herb Stein. That just can't happen, right? There's no place to go. You have to ask ourselves we ask ourselves as investors, so what does that mean for us? We've had much better returns if you've been investing for 35 years on leverage and rates have gone down. That, you know, your returns may be, you might want to say thank you for that, because that's not, you know, that's not likely to result in bad results unless you're really making underlying bad business decisions. As an aside, in the PE business, and then I'll go into other things, what returns do private equity investors promise their LPs? What's the return they promise? Does anybody get a view of that? Anybody? What do you say?
15.
Yeah, they say 15, but they don't get any return themselves. They don't make any money themselves until they basically give a 10% pref to the LPs. It's an 8+% pref, but then you take the management fees and everything else, it's effectively 10. So if the market is right, as Glenn said earlier, and as Laurie said earlier, that the world is going to be a low interest rate environment for longer, that's a heck of a deal, right? You have a 10% return before the other fellow makes any money. Alternatively, if the GPs reach their more traditional returns, which have been higher than 15 for first-tier funds, you have to wonder whether the value proposition of the industry is going to be dependent upon levels of risk that weren't taken before, right? Okay, slide 3. The current trajectory of rates is remarkable. It's not only remarkable in a nominal, in an absolute sense, but in a relative sense, right? Because it's only recently that equity markets have been beaten by the bond market in the last 15 years, right? That's happened again once before in recent history, which was during the Depression. So rates are historically low. How did we get here? Well, that's sort of a topic, another topic. You know, Steve Gorman was here, right? Wasn't the, what's the head of Morgan Stanley's first? James, not Steve. Steve's a friend of mine, different friend. James Gorman was here, and he talked a little bit about this. And I'm not going to get into the details of this, but if you look at slide 4, it's pretty clear that many economists have been projecting that rates will be better, that growth will be better than it has been for quite a while. And this is a little bit on the left, the output gap that Glenn referred to earlier. If you think about the current market growth, even though it's improved recently, relative to where it has to be in order to get back on trend, you'd have to have a heck of a lot of growth going forward. And this has had dramatic implications for the labor market on the right, and tells a story that we've seen before, that the recovery's been slower than in other post-war periods. Now, if Tim Geithner were here or Larry Summers were here, this is not the chart they would show. The chart would be, look at former or past financial crises, right? And look at US performance relative to those, and it's been, they would argue, materially better than it's ever been in the past. I use this one because I don't have to set that dynamic up. Let's just look at what's happened on a relative to US basis. Okay, slide 5. To bring this back to markets, in a normal recovery, pre-crisis, bond yields rise, yield curves steepen, equity prices rise, right? That's the norm. Rates and equities move in tandem. An improving economic outlook supports earnings, and the Fed turns more hawkish. Even in 2009, that was essentially the expectation. As the economy recovered from the worst of the recession, markets expected longer rates to rise in line with a more traditional recovery. That relationship broke down around 2010. And as growth disappointed, basically the growth substantially disappointed, and markets reassessed the likelihood that the future rates would stay low. The market went up and rates continued to decline. In slide 6, this policy response of the Fed to the crisis, and I would argue to a limited fiscal response, it was dramatic, right? The Fed just crushed rates, and it worked. Definitely worked, at least from a market perspective. Equity markets appreciated sharply. Unemployment, I don't know if the unemployment numbers have come out yet, but if they do, someone yell them out to us. They should come out in a little bit. Pardon me? 5 minutes, okay. Equity markets appreciate, I'll be done in 5 minutes. So equity markets appreciated sharply. Unemployment began a gradual decline, right? We've had 55 months of that decline, though growth has remained obviously uneven. At this point, I think it is really reasonable to ask how much of the market recovery was supported by the fundamentals of the economy and how much was driven by Fed policy. Slide 7. So a hint of this lies in the fact that rates have decoupled from the equity market as markets began to price in this concept of lower rates for longer periods of time. This decoupling became marked at the beginning of 2014, when the 5-year rate, 5 years forward, the 5-year rate, 5-year forward, collapsed. So it was around 4.6%, now it's running around 3.2%. One would expect that if you just cover that chart, you say, okay, we're at 4.6, right? What's the equity market doing? If the equity market were to do what it has done, which, although it's had its ups and downs recently, essentially go up, right? What would you have thought the 5-year forward would do? I think it would have stayed, arguably around 4.6, depending upon growth, maybe even a tick higher. But what it's done instead is to go down to 3.2. So the market is saying that rates are not going to be as high as they thought they were going to be. This decoupling is something that, if you follow this closely on a go-forward basis, it'll tell you a lot about what the market is telling us. So to reiterate, rates are low, growth has been elusive, the Fed reaction is playing, I think, a pivotal role in pricing risk assets and in market behavior. So 7 years after the financial crisis, economic conditions are far from normal. In a low rate for longer environment, some traditional relationships that have always governed markets and cycles and how they evolve, break down. And the historical analysis we use may not be as relevant. Slide 8. Now, what happens in America when things like this happen? Well, we invent things. We always invent things. This is the beauty of finance for me, maybe the beauty of the whole country, is that we react to what's going on in the world. And over time, we can react in really positive ways, sometimes not so positive, and invent things that we don't fully understand. But in this case, an example of this is something that's been around a long time, the MLP market. You all know what MLPs are. They distribute their cash, 90% of their cash. Historically, they've been in real estate, natural resources, and commodities. And if you look today at any of the big banks, they'll say things like this to their clients. These are retail clients for the most part. One of the best places to get current income is the MLP market. Okay, well, okay, I'm desperate for current income, so I'll go there. It's either, lending club on the net or the MLP market. I guess I'll go to the MLP market. Anyway, historically, MLPs have been concentrated in infrastructure funds, right? Pipelines, other E&P related assets, and have bond-like characteristics. right? It's supposed to be a steady cash flow, because the distributions are usually covered around 1-to-1, maybe a little bit better, and the structure is levered. So any shortfall can lead to a lack of distribution or no distribution. Stability is the key. Post-crisis, there's been a dramatic growth. So this is on slide 8. Dramatic growth in what's going on, including the creation of non-traditional MLPs, where the underlying earning volatility to investors is not bond-like. We call these at our firm, equities that are masquerading as bonds. And they're products that work in a low interest rate environment, but what happens if rates don't stay low? Page 9, this is an example of one of these bonds, one of these MLPs, we would say. A company called High Crush. I love that name, High Crush. High Crush sells sand used in fracking operations. It's a commodity subject to what you would expect, the movement of oil prices. If you purchased High Crush in August, you were setting it up with a dividend yield of 3. Well, that would be a remarkable multiple, the dividend yield of 3, right? But it's a commodity-like cash flow, and a lot of credits, a lot of companies have suffered from the remarkable move in oil, so that's not the problem with this. The market's way down. It's not just that if you bought it in August, you were thinking good things about the energy market. It's that structurally, this particular asset, it's really hard to see this being a stable cash flow. It really is. The MLP are far from, this is not the only one, not the MLP market is the only so-called yield co. You're now seeing the beginning of a number of utilities take specific assets, drop them down into holding companies, and issue securities off of those, some with really good cash flows, some with not so good, at remarkable yields. So if a utility trades at 8 to 10 and they drop something into a separate company, issue their cash flows off of that could trade at closer to a multiple of 20. So obviously a lot of reason to want to do that if you're a utility looking for aggregate value. A little bit of this is happening, a lot of this is happening in the REIT market, in the BDC market. And I'm not saying that every one of these markets is playing it incorrectly, but you've got to look at the underlying asset and assess the quality of the cash and the stability of the cash coming off that flow of assets if you're going to value it as a classic yield asset. Okay, slide 10. Here's another product that promises high current yield. It's called the PIMCO Global Stock Plus and Income ETF. That's a mouthful. With a name like Gallogly, I'm always looking for names that are funny. Okay, it invests in equity and credit securities, right? And then he transforms those securities into current income using leverage and derivatives. And it trades, it's always traded. How would you trade this? Well, it's going to trade near its NAV, right? Because that's what it is. Post-crisis, that's exactly what it did before the crisis, but post-crisis, that whole relationship between how it trades and its NAV has completely broken down. And now you'll see on the chart on slide 10, that it trades at about a 67% premium to its NAV. It's trading, it's got a 10% dividend, which means it's generating 15% cash yield off those assets. In today's market, how can you generate a 15% cash yield? It's a little like that email you got from somewhere, you know. I won't say what country, but you got it, and just trust me, I can get you a hell of a rate. Anyway, 15% cash yield, you got to be skeptical of this, and there's good reason. Instead of this being driven by the profitability of the underlying instrument, this is really a case where about 30% of the distributions here are a return of capital, right? Not a return on capital. Lastly, let's look at a totally different example, which is the central bank example that Glenn alluded to a few minutes ago. It's counterintuitive, but European high yield today, I think it's counterintuitive anyway, trades at a tighter spread than US high yield, notwithstanding really fundamental differences in outlook for the US economy and the markets in which European high yield is being issued. If the US market were not at the 6% that Laurie referred to as being more the 10-year norm from 58 to today, but maybe 4%, what would this market do? Or what would happen? How would you reprice the high yield market, particularly in Europe? If you look at sovereigns, and you take a look at European sovereigns just for a second, I don't have a chart on that, fooled you on that, but anyway, European sovereigns. Bulgaria just issued its largest issue ever at 3.05%. Now, Bulgaria is the poorest country in the EU, and you have to wonder if the 10-year were 2.3, is 2.3 today, if it were 4, what would Bulgaria be issuing its rates at? And, you know, changing availability of capital premised on certain interest rates, if that rate changes, what happens to the underlying economies, particularly of ones that have been really bullish from a point of view of investors pouring money into them. So where do we go from here? Let's think about the potential. I'm not going to answer Glenn's question as well as he'd like, I don't think. But anyway, let's look at the bookends of this, right? One side versus the other side. Now, one argument would be that, essentially on slide 12, the market is basically right, right? The market is basically right. We were talking about this with a couple of people before this presentation. I think you're going to have some very interesting panels, by the way, because they all have different perspectives on this. But if the market is right, you'd say you can get growth, pretty good growth, not accelerate inflation, rates remain pretty low. You can get a period of prolonged deflationary growth. I don't have that chart in front of me, but I think it shows industrial production tied to what's going on in the markets. And that would be excellent for credit, right? Be good for credit. Rates actually do stay low. And it would be supportive of the current equity market, maybe even supportive, depending upon growth, of a stronger equity market. As long as rate volatility remains contained, the market can absorb the normal shocks that take place in the world, and life could be good, I think. Slide 13 says something else that we should note, though. The markets have often been wrong. Markets have often been wrong about where rates are going. So if you think, again, back to this 5-year expectation of 5-year rates, this chart tries to look at the 5-year expectation of 5-year rates on a 5-year lag, right? So in other words, what did the market think the 5-year was going to be? What did it turn out to be? You know, typically markets would expect rates to be upward sloping. That's not a surprise. So it's not surprising that actual rates have been lower than what the market thought it was going to be. So there's been a disconnect. And today, if we look at the 5-year, 5 years from now, the market's expecting, as I said before, about 3.2%, about the same level that it was when Ben Bernanke announced the taper. And it's pretty, I think it's pretty remarkable given that QE's just ended. So, if that's one side of the bookend, life stays good, growth continues, rates stay relatively low, even despite the market's inability to accurately predict rates. What's the other end? What's the other side, right? The other side, I think, would be that the market gets really surprised, right? That rates pop. One of Malcolm, who's here, would say that's not going to happen, I think, right? But if I look at it and say rates really pop, market gets caught off guard, is that far-fetched? Well, let's say that growth is stronger than people are expecting, which I think it could be. That the 5.9%, it's almost 5 minutes, we'll find out where the monthly numbers are, but it continues to go down. That the marketplace doesn't have a lot of people who are now on the couch coming back into the market, and you get wage inflation, which in our businesses, just as a quick anecdote, that's definitely happening we own about 31 businesses in the United States, and we're seeing that now for the first time, not across the board, but in many cities, specific cities in the country where no surprise, labor has really become tight, and in certain industries. So, for example, in the driving industry, people, driving a truck is not an easy thing to do. It's difficult, actually, and you're really finally seeing wages rise in that market. Producers, drivers, trucking companies are finally also able to pass through price increases. So it's happening the way you would expect it to happen. We hadn't seen that for many years. Okay, if you believe that would happen, then rates could hike and the market could get surprised. What would that look like? Well, if you look on page 14, this is an attempt to think a little bit about what happened in 1994 when Chairman Greenspan surprised the markets. Right, he increased rates that had been flat for 5 years or so, increased rates about 200 bips, and the equity market reset. A key feature of that move, that it was in response to strong growth. A reasonable conclusion is that growth may not be enough if valuations today are too dependent upon rates. So if you don't get growth sufficient to offset a real rise in rates, and you'd have to ask, well, Janet Yellen knows this, so that's not likely to happen. And I think, that's the debate, right? Those are the two bookends. Okay, slide 15. What might an unwind look like? What might an unwind look like? Another way to think about it is a couple of examples of recent volatility. These are more modest examples, but in mid-13 you saw people really sprint to the exits when the mere suggestion of rate increases reminded people of the mid-90s. Taper talk and fear that the Fed would finally raise rates caught the market a bit off guard. The second example would be in August, September 14, when concerns about global growth pushed the market toward a view that QE should last longer. In both cases, high yield, not surprisingly, underperformed. When the market is this tight, as tight as it is now, investors don't stomach a lot of volatility. I'm almost done with these slides. You've been good students. I haven't heard too many papers referencing. Slide 16. If the rate picture changes, how will the unwind compare to other past experiences? This is something that I think your panels may have better views on, more informed views on. I'm sure they have a lot of informed views on. But on this particular one, I'd be interested in hearing back how you thought about it. Whenever you're looking at history, you have to think about the context for change within that historic period. And one of the things that's really changed is the liquidity in the whole markets area. So we've had the growth of ETFs and the growth of mutual funds. And ETFs and mutual funds are daily redemption businesses, right? The underlying instruments, however, trade a really tiny amount each day. And traditionally, dealers bridge the gap, right? They bridge the gap by holding inventory. They step up when liquidity is short. Now, post-crisis, the regulatory regime has changed. And dealers hold a fraction of what they used to hold. At the same time, credit has grown. So this is the left-hand side of that chart. Credit through the roof, dealer inventory going the other direction. If investors demand liquidity all at once, right, this shock that we talked about earlier happens, then the market, it's possible the market is full of sellers without that many buyers, with a market maker who's light on inventory, and that could exacerbate the jump in volatility. Slide 17, try to take a look at this by looking at Puerto Rico. In the summer of 13, since the muni market has some of the same characteristics as the ETF market, shallow liquidity, summer of 13, a series of really negative headlines about Puerto Rico sparked a complete sell-off in the credit of the island, and prices gapped down. Ultimately, non-traditional buyers, most hedge funds for the most part, emerged, but not before the par buyers were crushed, right? And that could be a good example of this liquidity issue, because the muni market and the current ETF market share a very shallow group of inventory makers or market makers. Slide 18. In addition to supporting low rates on security prices, the rate environment has also obviously had an effect on things like leverage. So very inexpensive leverage, right? And today, you see this slide showing like a 4.4 times turn interest coverage. That's basically EBITDA. It's not true interest coverage. Companies have CapEx and working capital, but that's a measure that the market looks at. It's also been an increase in duration, which itself, should be a concern from an investor point of view. But if borrowers are required to refi, and refi, let's say, at the high yield rate of 2007, which was 8.1%, then, as opposed to say 5.5%, then what will happen? Well, that coverage, instead of being 4, would be about 2.7. And so there's another way to think about what happens if markets move quickly. I think a lot of that should give us pause and maybe set up your panels a little bit. Rates are really low. There's a reason to think that markets have reoriented themselves to assume that those rates stay low for longer. But the unwind has the possibility of being faster and therefore more dangerous than expected. As an investor, how do we play that environment? On the control side of our business, we think about it a few ways. We look for businesses that don't require low rates to work, and businesses that we think can gain share. We're also very active looking at structures. We'll give up upside to take downside protection in businesses, and do that in about 40 or 50% of the long investments, equity investments that we make. Recently, for example, we're buying a business that we would own a lot of the equity and all of the senior secured debt. And we try to make sure that we're covered in any environment. In our non-control business, in our liquids business, we remain more wary. We're focused on absolute returns, not on specific yield, and select securities that we think have a more idiosyncratic return potential and a margin of safety. We don't use leverage we have leverage in the underlying securities, not in the fund itself, and we try to keep enough cash that if the world changes, we can change and take advantage of that. So we're in an unprecedented environment. Rates are low, both on absolute and relative basis, and I think there's danger that a highly accommodative market, both in how risk is priced and how financial products are designed, means that you can be surprised by circumstances changing. For me, if you're patient and understand the underlying asset that you're buying well, then I also think it's an opportunity. Thank you very much.